Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. Thanks everyone for being here. Today is Monday, August 25th. A lot to talk about today. In the interest of keeping everyone informed, of course, we will talk a lot of current events today. We're going to meet up with Jeff and James just to talk a little bit about what's going on in the market, a little bit of fireworks on Friday caused by Chairman Powell's comments. We'll also do just a general market update. And then after that, we will meet up with Kevin. Jeff and I will talk with Kevin. Kevin and I were both at competing conferences, industry conferences a couple of weeks ago. So we want to talk through Kevin's conference, which was the AI Summit hosted by HousingWire down in Dallas. And then I was at Western Secondary with many of you out in Terranea. So that was a California MBA conference. So a lot of great topics discussed there. We'll talk about what the topics were, what the mood was, kind of what the trends were, anything that we learned, and give you kind of the up-to-date on that. Before we go there, just in the way of data, OBMMI 6.57 as of early this morning. So looking pretty good there, getting close to that 6.5 handle. We're not seeing quite a spike in volume yet as a result, but I think the closer we get to 6%, we will start seeing that. 10 years at 4.25. So starting to see a better spread between those two, between the OBMMI and the 10-year. Yeah, but no big spike in volume coming off just rates being quite a bit lower now than they were kind of mid last week. So we'll keep a closer eye on that. All right, let's go talk with James and Jeff about generally what's going on in the market. All right, James and Jeff, welcome. Thanks for being here to chat a little bit about what's going on with rates and the economy and the Fed and just jobs and all of it. I mean, where to start? Maybe we start with the most recent, which would be Friday's comments by Chairman Powell. I think, I used to, in school, they would teach you, back then it was Alan Greenspan. They'd say, if Greenspan's words are slightly different than the last time he spoke publicly, that means something, right? And I think that carried through with Bernanke and Yellen and now with Powell. And the words were slightly different, right? Jeff, you made the comment. It feels like the pundits are saying he's suddenly gone dovish, but it seems maybe a little bit more like he's gone into the middle instead of being that hawk, right?
Right. He definitely made some comments, like you said, a little bit more dovish, focusing more on the employment situation, but it wasn't like a dramatic overcorrection in that regard. But as you said, any slight tweak, has everybody in a tizzy. Reading the tea leaves here is what everybody loves to do. But it was his first main chance after the most recent announcement to react to then those jobs numbers, and the revisions that came out a couple days later after the Fed announcement. So, I'm not sure if there's anything too surprising when you look at it in that regard.
Yeah, good point. I think, let's talk about those jobs numbers again. We've talked quite a bit on this cast, but they seem to be getting fully digested by the masses, right? We had a poor number in terms of non-farm payrolls that came out for July and early August, and then huge revisions for May and June, right? But there's a lot going on there. We still have an unemployment rate that's relatively low at 4.2, right? And unless it gets 4.5-ish, historically, the Fed does not need to act, right? Or it's not kind of a compelling case. So, and James, you had some interesting comments earlier just on the dynamics, right, of this. Like, we've never seen quite a market like this, especially in terms of the interaction with like the White House policy, right? A big part of this jobs story is what's going on with immigration.
Definitely. Well, back in the 70s and 80s, as the interest rates came up in an effort to fight inflation, there's a strict balance that has to be met there, right? It's inflation and unemployment, and how can you fight it? And they chose to fight inflation at the cost of employment. And it was definitely a difficult period, but they had the backing of the administration, the Fed did at the time. It's very clear that the administration has made its decision that unemployment is the number to target this time around. And so with, the pressure that's on the Fed, the numbers do encourage that we could look at cutting the interest rates, letting a little loose into the system, trying to get employment moving a little bit better. Even if it's not bad, having it move a little bit better is what they want. It's hard to say that would be the wrong decision. It's the decision of the time, that it's a hard balance, and there's an outside force that sees the way it wants to go.
Yeah. I mean, the inflation picture still looks good, right? If maybe tariffs were a little more certain, or maybe if the effect of tariffs were more certain, we would have cut rates by now. Because even though we're a little above 2%, as you pointed out, Jeff, anytime there's a fight against inflation by the Fed, there's a tail on it, a really long tail, right? And we're probably towards the end of that tail right now.
Again, James said, going back to the 70s and 80s when Volcker was fighting inflation, that was a very obvious time where there was a super long tail. And so, it got down to 4%, and then it took a long time to get down, further below 4%. So, I think some of this is normal, that the Fed is continuing to fight inflation, but still probably generally headed in the right direction, albeit slowly. But yeah, with these external forces, I guess if you call it, on both the employment side and the inflation side of tariffs, what are the effects of tariffs on inflation? Is it a one-time increase, or is it a gradual increase that's a true long-term inflation trend? Still have to, look through it in that lens. And then on the employment side, as you said, the effects of immigration. So we saw these, really low jobs numbers with the revisions, really low jobs numbers. But if you look through through the lens of immigration has fallen off a cliff, and a lot of times increases in employment are coming from immigration, then, maybe those numbers kind of make sense. So it's, we're getting ourselves worked up looking at all these things through the lens of, quote, normal environments. But, we're obviously not in a normal environment with kind of the I'm going to use the word unprecedented policies of this administration.
Mm-hmm. Yeah. I mean, the unemployment, just to underscore it again, there's so many dynamics to it. But if you were to look at the employment data purely on its own, you would say looks fairly healthy, right? But then you see that there's mass deportations, there's immigration, like you said, is down to zero. Even, non-US born workers in this country are afraid to go to work in a lot of cities, right? So they're needing to be replaced. So the economy is not needing to create jobs to keep people employed. Like, that's the reason why we're creating very little jobs, yet the unemployment rate is staying low. Like, has to be a big reason that's happening, right? So I think more of the articles you read about the job market being sicker than it looks are probably right on. Right. I think there's a lot more of that kind of rhetoric out there, and it's likely absolutely true. Folks that are getting out of college right now, for instance, are finding it very difficult to find work unless they're in healthcare. Really, that's where the majority of the jobs came from in the July number.
Yeah, I've seen an interesting stat that it's roughly 6% of college-age men graduating with a degree are currently unemployed, and that's not only the highest it's been potentially in U.S. history, it also now matches with the rate of the same age men who did not attend college. So getting the degree is no advantage effectively over not, is what the jobs market is kind of flagging with that rate. Healthcare did pick up, but the rest of the market's very flat. And to your point about, is it maybe a little sicker than we know? I spoke about it previously, but the Bureau of Labor Statistics and their perhaps hampered ability to get the numbers that they want and actually see what's happening is definitely a factor at play here, right? That unemployment rate is 4.2% based on reporting by the Bureau of Labor Statistics, which is only as good as they can get. So there's definitely, a margin of error there to be aware of.
Right. And as we pointed out before, 72,000 jobs in an economy as large as the U.S. is like nothing. We could see a revision to the negative in the next print, right?
Yeah, I was just been reading a lot of, there's been a lot of Fed speakers lately, obviously. A few interesting things that reminded me of something, I think it was Goldsby was mentioning, you're kind of looking at these jobs numbers as plus or minus 100,000 jobs, which to your point, 72,000 jobs plus or minus 100,000 is negative, right? So we are picking apart some numbers that are very rough around the edges in a normal environment. And then to James's point, where the BLS is potentially, hampered in their data collecting mechanisms and reporting capabilities, even tougher to get a read. So you take all that in aggregate, again, going back to some of the Fed speakers I've been reading, more and more of these Fed speakers are talking about, they kind of are just saying, I don't know. There's a lot of uncertainty about which direction they should be looking. Right? Should they be looking closer to the jobs numbers? Should they be looking closer to the inflation numbers? And then within each of those numbers, you can tell a story in either direction, more so than you have been in a really long time. Again, Barkin, the Richmond president, was talking about, 3 out of 4 times, it's pretty easy to figure out what the Fed needs to do. This is kind of that 1 out of 4 times of really a lot of uncertainty and not sure about which direction the Fed should go.
Yeah, it's like they can't use that data dependent excuse right now. Like does the Fed need to read the tea leaves a little bit, because the data is telling you one thing, but the average American is telling you a different story, and you have to make decisions based on that, or you will be, quote, too late, right? With making a move this time around. And maybe we're at the end of the tail. Maybe things balance out with tariffs, but are we late to rescuing the job market? Or that has a lag on it as well. What we don't need, I'm sure, is 5-6% unemployment, or at least this college graduate unemployment number to go from 6 to 7 to 8 to 10% and really cause a weird dislocation in the market. Or maybe this again is part of the White House's plan, right? I mean, they're looking to transform not just global trade, but also the labor market, right? I mean, a big thing that happened last week, for instance, was the Intel investment, right? The U.S. invested in Intel, and they've really, that was done for one reason. It was national security was one piece of it, but also American jobs is another reason that I think the U.S. government will continue investing in private businesses, is to bring more jobs here domestically, right? But they're not all going to be white collar jobs. A lot of them are going to be in the trades, and that's been a huge promise of the campaign, right? Is to bring more manufacturing jobs, especially to the U.S. And that's not necessarily always a college educated person who's taking those jobs. So there's going to be a transformation of that market. It's not going to happen in 6 months, right? It's going to take the rest of this presidency and likely beyond to make that complete change.
Mm-hmm.
I think a good pivot off what you're saying there with the administration taking, I believe it's a 10% stake in Intel, it is kind of a good view into the GSEs and what might happen there. So the administration was saying this is the start of the sovereign wealth fund that Trump had signed maybe in early January with an executive order that they wanted to start. They want the government to have a stake in U.S. companies, encourage manufacturing and other jobs at home, and just to help build wealth for the country. Part of that, as we are waiting for the GSEs to potentially come out of receivership, is how is that going to look? How is it going to work? How will they maintain the full faith and backing of the U.S. government behind their credit? And the answer might be, as they come loose, that the government would maintain 10, 20, 25% of a stake in them and consider that part of the sovereign wealth fund. That's quite possibly what we're looking at there.
Yeah, that's a good point. I mean, it definitely, if the government's going to do that in a company like Intel, right, a publicly traded company with no government intervention up until now, then they'll definitely do it in something like the GSEs, right? So it definitely removes that barrier of concern about what does privatization mean. It doesn't mean too much if they're doing that with a company like Intel, I guess, right?
Yeah. I mean, that was, sometimes it's tougher to read nuances in, maybe a tweet from the president, different than trying to read, Powell's pre-selected comments. But there were comments when I think back a couple of months ago where they were talking about, Pulte and Trump were talking about privatization. And a couple of times they mentioned like a kind of quasi privatization or a semi-privatization. So it makes sense that in the back of their mind, they may have been thinking this sort of de facto sovereign wealth fund that was created essentially, I mean, it's not official, but by putting 10 billion-ish into Intel, it exists now that the American taxpayer owns part of Intel by way of the government. So if they do this something similar or even bigger, probably with Fannie and Freddie, it could help with some of the uncertainty around the guarantee, some of the uncertainty about where all that money goes now that they come out of conservatorship, it could be kind of a win-win, I suppose, if done exactly the right way.
And it does make sense, like employee stock option plans, or there's a lot of unions that one of the things they try and do is they try and gain a large or a voting block share of the company that they are, representing the unionized workers of. That way they have the ability to vote. They have the ability to say, hey, we're going to move this to Mexico. Like, no, we're voting against that. We want to keep it here. Having the U.S. taxpayer own it, the government own it, it's not just the ability to regulate and pass law that would stop it. They have the ability to vote in shareholder meetings and who's the CEO, who's the board, and try and sway some control there. So it's a different approach to how the government can levy power against these large companies.
Right. That could end up being the case. I think with Intel it was non-voting shares, but that doesn't mean in the next case that it wouldn't be voting shares if they decide they want to maintain some control, like in the case of the GSEs. I think that's just a different animal because it's been nationalized for so long. If I can use that word.
Look, regardless of if it's voting or non-voting shares, I think it's silly to think the Fed wouldn't exert some sort of, the federal government would not exert some sort of control over these companies. So maybe the last couple of minutes here, we can kind of tie it back to looking ahead a little bit and some hard numbers. Jim, you had mentioned OBMMI at 6.57, lower, but not like crazy lower, right? I mean, the 10-year dropped. Obviously, we've got some volatility Friday. The 10-year dropped, but we're not continuing to drop here going into this week. CME has a probability of a Fed cut in only 3 weeks now, 3 weeks out from the September meeting at 86% right now.
Yep.
So, pretty well priced in that's going to happen. Even with that priced in, again, rates have dropped some, but mortgage rates are still 6.5 and above. As you said, volumes have not picked up, right? I think we need we probably need another, at least a quarter point drop in mortgage rates to see volumes, really start to pick up even more, would be my sense.
That's what happened last year. Last year at this exact time, almost, we started to approach 6% and volume spiked 50, 60%. It was a wild time, if everybody recalls, but it was a year ago, and it'd be nice to see, obviously, going into the holidays, because the holidays are otherwise very brutal in terms of mortgage and just housing market volume. But we may actually see something if we keep going. And you wonder if borrowers are sitting on the sideline waiting and hearing that the Fed's going to drop rates and thinking that's going to have a big impact. And it might, but it won't have the immediate impact because I think, as you said, it's all priced in, unless the Fed surprises us and cuts a point, or cuts a half point even. But the bets are on a quarter point cut here in 3 weeks, as you said.
James, anything else? Kind of last quiet week of the summer, but we do have at least one interesting number to look at this week, right?
Well, definitely. I was thinking, tomorrow, Tuesday will be consumer confidence. I thought was always something to kind of keep your eye on, especially as we have these conversations about, what's kind of the fogginess of the market, what's everything looking like. There's also, well, how does everyone else seem to feel? Maybe it's just us in our bubble, but I'm definitely interested to see on Thursday is GDP for quarter two. So I've kind of harped on this before, but GDP in quarter one was negative and people really responded to that, but there was a lot of front loading to get ahead of the tariffs. The GDP number looks pretty solid for quarter two. It's about 3.1% is the estimate, but that's almost the pendulum swinging the other way. Now we've seen imports really drop off, which is going to push up the GDP number. So I would say be a little careful when that number comes out. There's probably going to be a reaction, kind of laughing about it, but there'll almost certainly be a tweet. Look how great the GDP is. Look how good it is. But that number is at least a little inflated as it comes back from the one-time hit earlier this year.
Right. So don't be fooled by the GDP number. That's the message this week, because it's kind of a one-time gain that's coming from the shift in the trade deficit. Could happen more as we continue to increase tariffs on countries, but it feels like the biggest shock was, like you said, the negative number last quarter, and then the potentially 3 handle this time around. Yeah. I think that just about covers it then, gang. Good discussion. Good things to keep in mind here, y'all. I mean, we got 3 more weeks till the Fed meeting, and then GDP this week, and then we'll keep you informed on on kind of what the bets are looking like and how we feel about interest rates in the coming Fed meeting. Thanks, gentlemen.
Thanks.
Thank you for having us.
All right. We have a pretty cool update segment for everybody today. Kevin and I were planes passing in the night, if you will, a couple weeks ago. So Jeff and I thought it'd be good to sit down and have a recap on the conferences that we went to.
Yeah, some pretty big conferences. Jim, you were at, one of the biggest regional conferences there is, the Western Secondary. And then Kevin, you were at the HousingWire's AI Summit, which is, I think, second year they've done that. Really popular one, kind of the brightest brains in the industry at that one. Some pretty important conferences out there that y'all were both able to go to. So we thought we'd start with Jim. You kind of give a quick recap of general trends across the industry that people were talking about last week.
Yeah. As usual, Western really well attended. I think the numbers were, better attendance than the previous year. We were out at Terranea in California. I'd say that, the vibe was even better this year. Obviously, coming off of 22 and 23, it was a little bit rough, but this year, I think people were in pretty good spirits. It was interesting, like less and less talk about, traditional GSE space in terms of origination, even though that's still a vast majority of what's going on. Certainly talk about the GSEs themselves, with all the talk that we've had on this podcast, and you see everywhere about a possible exit from conservatorship. But I thought it'd be good just to go through just a couple things that were buzzing. Some of these might be obvious, but I'll let you know kind of what people were saying. Non-QM was a big one. It was, kind of felt more real than the past few years. The past few years felt like a little bit more talk, right? We're going to get into non-QM. We're going to start selling it, or we're going to start buying it. But there was folks actually originating it. And then that shows up in the volume. We certainly see it in our volume. We're up about 50% year over year in non-QM. I mean, granted that the total is still less than 10%, but it's up, from something like 5% closer to almost 10% now, and climbing, towards the end of this year. So it's certainly something that we've been focused on across Optimal Blue. Certainly on the desk, we've been learning a lot more about non-QM, even though it's definitely not in a spot where most mortgage banks are going to want to hedge non-QM necessarily. But we're certainly getting educated on it and using the ton of data we have across our systems to help clients figure out who's buying it, what the pricing looks like, what the major buyers smell like in terms of the right partners to have.
Yeah, there is a robust buyers market right now. There's a robust set of buyers out there. Again, maybe not quite liquid enough, and particularly, not enough maybe fundamental understanding of exactly how those things are priced where you can hedge it at lower volumes, but still plenty of buyers out there. We should feel comfortable originating those on a best efforts basis. Make sure you can, you have multiple outlets. I think that type of market is definitely out there at this point.
I think you're right. And you're seeing the big aggregators get into it now, which I think was a big turning point, right? You got AmeriHome and PennyMac buying this stuff, not Mr. Cooper. Those are entities that are going to be way less likely, I think, to turn around overnight or disappear overnight if there is a market disruption, like we've seen periodically over the years, where folks just get caught. Even in the world of best efforts, you just get caught with a buyer disappears or is no longer buying a product.
Yeah, and I'll give it one quick plug because I think it's an evergreen episode. Just a reminder, a couple of weeks ago, Mike and Vimy and I did a non-QM episode, and Mike give a really great overview of the non-QM market and different types of products. So I'll replug that episode from a few weeks ago.
Yes, definitely go back and check that one out. If you're at all curious whether you're a novice or an expert in non-QM, I think there's some really good information there. And it won't be the last time we cover that on this cast. When you mentioned fundamentals, it jogged my memory that some of the discussions were folks getting back to some fundamentals versus like the crisis mode that folks have been in the last few years, managing headcount and efficiency and some liquidity issues and volatility. It's more back to just like optimizing margin, optimizing your counterparties, right? Getting back to who should I really be selling to, whether it's in the GSE or the non-QM space, what broker dealers should I be working with, nailing down your hedge effectiveness, integrations, like how do I get all my systems integrated to get more efficient? Like how do I gear up for hopefully this next level of growth, right? Which we're seeing slowly, right? Sometimes it's easy to forget that we're seeing double digit increases year over year the last couple of years in volume. but it doesn't feel like it because we're not getting these huge booms, right? But we could. I mean, with some of what went on just last week with the Fed that we talked about, we could get one of those fall booms. How do we gear up for that without adding headcount? Also, consolidation, just M&A. There were some sessions on that, and just our meetings, I think, consisted of some of that discussion. We're still seeing consolidation happen. We're seeing companies buy other smaller or larger businesses, and how do the rest compete with that? How do I go from 10 to 50 to 100 million when some of the monsters are buying each other? And maybe it's, you do it now, you build up market share now while they're trying to figure out, the larger ones are trying to figure out how to integrate. The market is getting better. Again, a lot of talk around that, not just blind optimism like we had in 23, I would say 24, where we were just kind of hoping rates would go lower in the next 6 months. Like we are seeing rates slightly lower, but seeing volume go up nonetheless, because purchase business is continuing to improve and everyone's getting real creative on how to capture it. And then lastly, my panel I was on an AI panel, AI and automation, basically how to get better using AI. And I think it's sort of like non-QM, where like last year was just a lot of talk. People were saying AI, people were kind of proposing philosophically how AI could improve our business, our industry, but it's actually happening now, and we're walking before we're running, in my opinion. I think some of the lofty ideas are still just that. They're difficult to attain, but you are seeing folks use things in their own lives, like Copilot, to help kind of manage their day and to be more efficient. But we're also seeing, Optimal Blue for sure, and other platforms around the industry using AI just to make things easier and simpler, and to start learning over time to make things better. So I think that's something I think it's a good time to segue, because I really want to talk to Kevin. We have not met up since we were traveling. Just really want to talk to Kevin to see how the AI summit went and just what the topics were there and what the main takeaways were.
Yeah, so I went down to Dallas the other week and I went to the HousingWire AI Summit. It was really very well executed. It was very, very popular. It was standing room only, actually, for a good chunk of the time. I gave up my prize seat in the morning during the break, and then I wasn't able to get it back until after lunchtime. So a lot of folks there. I think HousingWire does a really good job of getting some of the best, minds in the industry all together in one room. A lot of great speakers. Seaver, our chief technology officer, was there. He had a really great presentation. Talked about it a little bit on LinkedIn. He went through different ways to evaluate your return on investment with AI, which I thought was really good. And he also talked about just the learning curve and excitement curve with AI, which has sort of repeated itself with different disruptive technologies. You sort of have this exuberance at the beginning. You say, oh, this is going to, change everything. And then, you kind of come back down to earth. And you realize kind of where the limitations are with the new technology, but eventually you sort of build your way up to this sustainable productivity that you have. And I thought he captured that really well. And I think certainly my standpoint here at Optimal Blue, I think we're much farther along in that sustainable productivity curve and understanding AI tools and how to deploy them and how to build with them and how to understanding the use cases where things are going to work the best. And so I do think it's for lenders, there's still a lot of lenders I think who are just in the process of starting to get their feet wet, and certainly encourage anybody who's trying to think about, hey, where do I go? How do I start implementing this? Leverage some of the partners that you have in the industry. I think Optimal Blue is a great partner in that regards, and helping lenders understand where they can see some of those productivity gains. Just since we've been through it already, we've come out on the other side, and we've learned a lot through the process. So certainly there to help any lenders who are looking for guidance. One of the big takeaways, though, that I would say is people are building stuff really fast is sort of the big message that I'm getting. We heard from some big names, UWM, Rocket, who are out there, and they are talking about building new capabilities in a matter of days or weeks, and building new AI agents kind of from here's our idea to actually deployed out there in production. And I think that's, very impressive that people are moving that quickly, but it does sort of make sense, when you think about it, and particularly, my understanding of AI agents and, how you kind of, actually go through the process of building these things. In a lot of ways, you're really just connecting plumbing of tools and data sets that you already have, and feeding that into an AI agent, which, at its core is, one way to think about it is just the Chat GPT assistance API. So you've kind of got all of these building blocks in place, and your job as someone who's building the AI agent is really just stitching them together. So there really is an opportunity to move very quickly, and start seeing some real value once you understand and kind of get up to speed with the learning curve that's there. Which, by the way, you can use AI if you're just starting to get your feet wet and you're like, I don't really know where to start. Well, you can ask Chat GPT, hey, where can I start to think about deploying AI capabilities to help maximize my ROI. It's really the first disruptive technology that actually helps you understand how to use it. So yeah, overall, very well done conference or summit. A lot of interesting speakers there, and there's definitely I think an appetite amongst a lot of folks who are kind of getting farther along in that learning curve to move very quickly.
Yeah, a lot of buzz out there right now for sure about all the cool things that AI is doing, right? We got into some of the boring stuff at the end because there's this, you mentioned how quickly it's evolving and how quickly it's being created. So we had to have a couple of questions on our panel about like, okay, that might sound dangerous to people, and it probably is, right? There's risks to deploying some of these thinking machines if they're not properly, if you don't have good policy internally, or especially if you build your own. These things or they compliance issues, right? That's like a whole web of stuff to worry about. Anyway, did they talk much about that at the HousingWire deal?
Yeah, I think that certainly came up, and that's actually something that Seaver has talked about as well. There's a few different ways when you're thinking about building AI agents to actually ingest the data or the tools that it needs to be able to understand your business and be able to perform functions. A couple of those. So there's what's called RAG, which is, you can kind of think of your data being kind of bolted on to the AI model, but you can do it kind of entirely within your own ecosystem. And then there's something newer that has a lot of promise called MCP, or I think Machine Context Protocol, which allows you, it's kind of like a framework for creating more plug and play type agents where you can connect them to different tools like over the internet and whatnot. And there's certainly, I think, if you're going to be injecting tools outside of your ecosystem with something like an MCP, there's a lot of security, that you gotta figure out as part of that process. It's certainly very powerful, but it's new, and it's one of those things where the security layer that's available there is gonna evolve over time. So, but yeah, that's certainly a concern, I think, both from the security perspective, also from the compliance perspective. So where is AI making decisions within, a workflow or your organization? Like, that sort of stuff gets really tricky. But there's a lot of applications, I think, where, you can set the AI, whether it's agent or whether it's Copilot or however you configure it, where it's not the one that's actually making the decisions. Instead, it's just serving that information up to a human. I think that's sort of the best way, I think, to manage the compliance risk of kind of the AI running ahead of what your organization's compliance standards are.
That's great. Yeah, I think the third thing I'll point out, you mentioned security and compliance, and you kind of touched on it with some of the things Seaver had brought up, but just something, Kevin, you and I live and breathe every day, right? Building software is just anything you run into with new software development, right? So, when system reliability is critical, you really have to think about how these things fully integrate into your entire ecosystem. And think about how you're going to maintain these and upgrade these, right? So, the very obvious example right now is ChatGPT 5 just came out. Our system, a lot of systems are built on top of Microsoft using ChatGPT for a lot of these tools. So making sure you have a robust process in place to move from, a previous model to a newer upgraded model. That looks, a lot of ways, that looks the same way you would upgrade anything. We're just kind of going through, a lot of people are going through the first rounds of doing those types of things, but you have to keep a critical eye on that. So while some of these things being built quickly are new and flashy, with some of these very complex ecosystems that a lot of our systems are built on top of, you just have to continue to keep a critical eye on those types of things.
Oh yeah, for sure. I think that's a good point. When you're building something, you do need to think about the maintainability, what upgrades, how is it going to, evolve over time. And I think this, the chat GPT and then also when your organization is going to be ready to take some of those upgrades. So, chat GPT 5 coming out in, the last couple of weeks certainly has been sort of an interesting story where even Sam Altman who's the CEO of OpenAI has mentioned that there were some mistakes that were made and maybe also expectations were pretty high amongst its user base. Sometimes it doesn't always pay off to be part of that, bleeding edge. I think, some of the early adopters for ChatGPT 5, there was sort of a clamoring of folks looking to go back to their, their 4.0 models that they were, more comfortable with. So it's definitely a tricky landscape to navigate because, you don't necessarily want to be the beta group, on a new model. But also you do want to make sure that you're staying current as some of these trends are evolving because things are changing very quickly.
Yeah, and the curve is steepening, right? I think about it. You could think about it in terms of like the iPhone. Like not many people had iPhone 1, right? I think my first was 4 or 5, but you could see it, but it escalated so quickly from there. And to compare the first few to what you have now, and considering it was really only, 10 years ago, maybe 15 that people got their first iPhones. I think it's just going to get wild here in the next few years. Everybody's projections are different on how it evolves, but super exciting.
Yeah, we could talk about this all day. I think there's a few other topics I wanted to hit on that we didn't even get to. So I'm sure this will be an evolving conversation, but it was really fun to hear the feedback y'all are seeing in the industry. I think it lines up, really well with what we're doing at Optimal Blue to toot our own horn a little bit. Something we all should keep a close eye on in our personal and professional lives, right? So, yeah.
Big thanks to HousingWire and the California MBA as well. Just two institutions that are doing just a great job of gathering and disseminating content. Cool. Good segment, gentlemen. Thanks so much.
Thanks.
Awesome. Thanks, guys.
Okay, let's wrap this thing up. Big thanks, James, Jeff, Kevin. Good conversations. I learned a lot today, so appreciate you. But that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Check out our full videos on YouTube. You can also find each episode on all major podcast platforms. Thanks again for tuning in to Optimal Insights.
If you're thinking about coming to the summit, it's a really great opportunity. I can't emphasize how valuable it is just to hear about all the new innovations, but also the networking opportunities.
It's a great place to network, and they've done a fabulous job with bringing in certain speakers from around the mortgage industry to kind of provide their insight.
If anyone is on the fence of whether they should attend this event next year, there's just jump over the fence. There's so much content that you are going to get out of this.
I definitely highly recommend coming. You get a lot of just engagement with the OB team themselves, but also get the additional knowledge and information about what they're working on.
You're setting your schedule for next year, for deciding which conferences you're going to be sending people to, you're going to be attending yourself. I mean, this is one that you have to show up to.
So our innovation is going to focus on the most important aspects of your job.
There's something so magical about being able to share our profitability expertise that only Optimal Blue can provide.
We're not just delivering software, we're delivering solutions that empower you to make smarter decisions, operate with more efficiency, and stay ahead of the curve.